Just an update here. The markets, have kind of been in this nowhere land for many months after the first stock crash into February of about 12%. Stocks have been going sideways in kind of a triangle pattern. Now they're finally breaking a bit out of that, but they're not breaking out strongly, and they're doing it on low volume. So it's still not clear whether the stock market is going to break up to new highs over the next few months or if it's going to break down. All I can tell you, if it does break down around 23,200 to 400 is a kind of critical area. If it breaks below that, then it's probably going lower. What is most interesting right now is the bond market. We've had this 10-year Treasury bond channel. I mean, it goes all the way back to 1989. It's this channel like going down like this in a very predictable range. And boy, when it gets to the top of that, you buy bonds looking for yields to go low, and when it gets near the bottom of it, you sell them. And this has been a great indicator. And for the first time in 40 years, we're breaking just above the top of that channel. We told people to start buying 10-year and 30-year treasuries around 2.99% return, and that was right at the top of the channel, because that's normally when it's most profitable to do. But if it is going to break up above this, it could break up substantially. So recently, you probably noticed, and you should take notice, Rodney tightened the stops very significantly on our bond positions. We may have to take a small loss, but man, if this thing does break up much more, it could go to 4 to 5% yields. Now that's going to be the ultimate fixed income trade of the decade. That would be wonderful for us, because people don't understand, we still haven't seen the deflationary phase of this winter season because of quantitative easing, basically just blew it out, just turned it off. And we only saw a brief period with some deflation. So once we see deflation, that's going to cause bond yields to go lower. There are many people, in fact, the consensus on Wall Street now is we've seen the bottom in yields for 10 and 30-year treasuries long term, and they're only going to go up from here. I do not agree with that. I think this is a bounce in yields, a late stage inflation period, which is something we've been warning about. And now that we've broken above 3%, and it's at 3.11% on Thursday, this thing could break a lot higher. If that happens, that will certainly be a trigger for stocks to decline in real estate. That would kill real estate, especially if you look at this channel, and this break really is significant, and it does continue. And we're giving it a little leeway, but not much more here. I mean, it really says we should go to about 5%, a little bit higher. So that would definitely be bad news for the stock market and real estate, and probably be the trigger for the next crash. So that's interesting. The other two things that are interesting markets, the dollar was between 88 and 91 like for months and months, just going nowhere. Well, it finally is broken out towards 94. And of course, we think it's going to go a good bit higher over the next year or so. And, I put out an update recently, said, we've been saying gold, which is the other interesting thing right now, would bounce from 1,050 to 60 way back in late 2015 and go to at least 1,375 and maybe as high as 1,428. Well, this rebound in the dollar, which looks like a clear breakout, is going to limit how much gold can rally or not. And gold is actually now gone down to, last I looked, at $1,280. And at about 1270, it breaks an important trend line on the lower end and could start crashing again. So I think we may have seen the best in gold. We achieved our minimum target, and I would say the odds are now gold is not going to go above 1,375. So a break below 1270 would be, you better get out of the way again. So these, gold is now making a more concerted move. Bonds are making a concerted move. The dollar. Stocks are the one thing that are still kind of like, oh, are we going to go up or are we going to go down? And the reason I think they're probably a little more likely to go up is my models show, and very clearly, and I've written about this in the past, and boom and bust and leading edge, that when a bubble of this magnitude finally bursts, you typically see, and out of the 7 stock bubbles in the last century, average 42% drop in the first 2.6 months, anywhere from 2 to 3 months, and anywhere from 30% to 50%. But that, we haven't seen that. We're already, 3 months or more from the top in late January, and we haven't seen this. That tells me that this sideways correction is probably more correction and not an initial crash. On the other hand, if bond yields do keep climbing up, that's going to be headwinds for stocks. And so again, I would still favor the upside on stocks. Stocks are the least clear. But a break below, I'd say about 23,200 on the Dow would be a sign that nope, the downside may be playing out and we could get a rapid crash. So most trends look kind of clear now except for stocks, and we'll just keep you guys updated.